Hello and welcome to the Assay TV. Today I have Bert Koth, Managing Director and Partner at Denham Capital Mining Fund, here with us today. And today we're going to be talking a little bit about risk capital scarcity in mining. Bert, thanks for joining us today.
Hi, Amy. Great pleasure to join you for this conversation.
Thank you. And so I guess let's begin talking a little bit about share prices. So these have been rising as part of the overall equity market recovery. So can you maybe speak a little bit about capital scarcity and what you're seeing right now?
Yeah, I mean, clearly the share prices of junior mining companies in line, as you've said, in line with the equity capital markets recovery since COVID-19 have seen about a 33% rise outside the gold sector. That is quite significant, and we hear regularly all the time people say, well, the share price is up now, so therefore it's going to become easier to finance projects. Now, outside the gold space, we actually don't think that's the case, because the rises of the share prices are due to people trading, and a lot of companies have actually fairly limited trading liquidity. So therefore, in many cases, it does not require a lot of capital to actually materially move these share prices and increase the market caps of these companies. Now, that means that in many cases, relatively limited pool of trading liquidity does not mean that actually the development capital to kind of develop many of these metals and mining projects is actually available. So these are actually two different things. While it's certainly helpful for capital raising that the share prices have increased, it does not mean that the capital for development is available. And many people don't distinguish between those two.
Okay. And so how much capital is then available right now?
Well, that's a great question. I mean, let's start by looking together at the last 12 months. So with the last 12 months, approximately 6.8 billion US dollars of equity have been raised by the mining industry, right? So as a starter, that's not a lot of money if you consider that the metals and mining industry has approximately 1.7 trillion US dollars of market cap, right? So then let's take a look at those 6.8 billion dollars. And by the way, this is all based on publicly available information. So only about 25% of these 6.8 billion US dollars have been raised for developing mines. Yeah, and that's actually surprising a low percentage, because one would think that when mining companies raise capital, they would spend the majority of that capital on developing mines. But it's actually only 25% of the equity raised was actually spent on developing mines. So that's approximately, whatever, give or take 1.7, 1.8 billion US dollars, something like that, of development equity that has been raised for metals and mining. Now, then let's unpack these 1.8 billion dollars further. About 60% of that capital has been raised by the gold industry, and only 40% by mining companies outside the gold space. So if you actually roughly make the numbers, you'll find that means there's only been 690 million US dollars of equity raised from mining projects outside the gold sector. And that's actually a really small amount of money, given that the mining industry is approximately, as I've said before, 1.6, 1.7 trillion US dollar market cap industry. So over the last 12 months, clearly hardly any development equity has been raised for mine development outside the precious metal space. Now, another great metric to look at is probably what we call is the multiple of required development capital over the market cap of the companies that actually own the projects that need to be developed. And so that multiple is quite surprising. So first of all, let's look at the junior end of town, because this is where the real risk capital is needed, right? So obviously, if you look at that multiple for mining majors, it's of course a very low multiple, right? So in the gold space, that multiple is approximately 2x. So that means gold miners need about twice as much capital to develop the projects on the books than the underlying companies are worth. And I'm talking about the junior companies right now, gold juniors. Now, that is a manageable hurdle, because they can go out and do streaming, and there's a lot of kind of cheap public market money available for gold, et cetera, et cetera. But if you actually go away from the gold space and you look at mining juniors in any other metals or minerals, that multiple, according to our calculation, on average is a 6.8x. So which means junior companies that have projects outside gold need approximately 6.8 times as much capital to develop the projects on the books than the underlying companies are worth. And that's a very, very high hurdle. And that hurdle has become lower. So a year ago, or 1.5 years ago, that multiple would have been a 15x. Yeah. So it's because of the share price increases that multiple has come down, but it's still a very, very high hurdle. And this is also true for all the kind of green metals, technology metals companies. Doesn't matter if it's rare earth, lithium, nickel, right? They also, juniors in that space, still face this very, very, very high financing hurdle. Now, what that means in reality is that the majority of these projects is going to end up financially stranded, because either the companies cannot raise the equity, or even if they can, it's very difficult to see how the boards of directors of these companies would endorse the capital raising, because it would result in massive dilution for the shareholders in the existing companies. So outside the gold space, there is clearly a significant scarcity of capital that is willing to assume the development risk in mining.
Interesting. I mean, one would have thought that with the ongoing energy transition and the focus on decarbonization these days, that financing for green metals and mining wouldn't have been, I mean, such a problem right now.
No, you're entirely right. From a purely thematic point of view, one would believe that there's a lot of money getting mobilized. Yeah, but the factual numbers that we have in front of us are telling a different story, and it obviously does not help that, for example, in Western Australia, a lot of lithium projects have gone bankrupt, right? Essentially wiping out all the equity that's been invested historically, right? It obviously also does not help that also, for example, in the earth space, right? Yeah, there have been projects with significant problems in the past, right? That are kind of very detrimental to equity investor returns, right? It does not help that in, for example, in nickel, which is also kind of regarded as a key battery metal, right? A lot of the projects have very elevated execution risk because the laterite nickel projects, right? So it's complicated. That's what I'm saying.
Yeah, absolutely. And I guess maybe we want to talk a little bit about how ESG factors into kind of this financing aspect.
Well, ESG, I mean, first of all, having the right and positive environmental and community and stakeholder engagement and policies is the social operating license for any successful metals and mining project. So I'm just making this as a kind of as a starting observation. And while obviously the media usually focus, understandably, on the negative events like accidents, right, or tailing stem failures, or when historically sensitive heritage sites are being blown up. I mean, these are all terrible things that should never happen, and obviously the media focus on that. But what is probably not understood by mainstream media and the broader public is the fact that actually in the vast majority of cases, mining companies really do the right thing. for the environment and for the communities. And what is equally also not understood is the fact that a lot of these metals and minerals are actually necessary to deliver the kind of energy transition. You'll need much more metals and minerals for the electrification, for electric vehicles, for renewable energy than, for example, can be recycled. So there is this kind of direct link between achievability of a zero carbon future and the need to actually significantly increase primary mining. And that link is not understood at all by the broader public or also by the proponents of energy transition in most cases. So I think what is happening is that in some cases ESG might be misunderstood by people, by investors, as a reason for not investing into metals and mining, with the long-term negative consequence that that means that it's actually even less risk capital that can be mobilized for metals and mining, and that will then have the knock-on effect that there's going to be a significant supply shortage further down the track in certain metals and minerals, and that supply shortage might put the achievability of a zero carbon future and energy transition itself at risk.
Absolutely. Yeah. And so, what do we do if this capital scarcity that you've been talking about, what do we do if that persists over the next few years? Or
it's a really difficult question because needless to say, those companies that are in production and those projects that will have succeeded in bringing themselves into production will likely be great beneficiaries of rising prices, and shareholders are going to do very well. So yeah, for those projects that succeed in bringing themselves into production, that's really good news. Yeah. But then for society, for broader society, and for the desire to achieve energy transition and a zero carbon future, that's not good news, because when you actually have much higher prices, it will ultimately push up the prices of renewable energy and electric vehicles, and so that actually then stands in the way of achieving these very important objectives. So I do think, public education is necessary. That actually the mining industry is actually really important for achieving these objectives.
Yeah, absolutely. And so
I have no easy answers to this question, because I don't think there is an easy answer.
No, for sure. So you're coming at this from the private equity perspective. And what do you see as kind of your role and the role of private equity in this space, in helping kind of funding these types of projects?
Well, obviously, we as a private equity firm, and as is well known, most of what we do is actually to assume the execution risk to develop projects into production. And we have in our fund certainly a very strong focus on those metals and minerals that are very helpful and necessary for an energy transition and for general electrification. So that is certainly our mandate, but overall, the pool of private equity that is out there is by far insufficient, to kind of solve all these funding needs that are out there. Today there's, again, I'm making an intelligent guess. Maybe there's $6 billion of still deployable private equity capital in the room in metals and mining. That's really not a lot, and and that pool might shrink further, since not all private equity firms that exist today will probably raise follow-on funds. So that pool might actually be a little bit smaller going forward. But it's in any case, even if it grows somewhat, it would still be insufficient to address to address the funding requirements in full. So we as private equity investors can certainly step in and provide the development funding to some of these projects. Yeah, but the holistic funding solution would require additional capital beyond private equity.
And where do you think that capital is going to come from? I guess beyond private equity. Can we look at the streaming, or what is the right kind of finance mix?
Streaming, royalties, mining specialized debt. I mean, they are typically all part of the funding mix for one particular project. Yeah. So they are not funding alternatives. They're very complementary, right? Because even if a project is financed with a royalty financing or a stream or with a debt product by a fund, it still requires equity as well, right? So it means all these different funding mechanisms are actually not substitutes, alternatives for each other, but actually quite complementary, right? So they're usually part of the funding package, right? So if anything, royalties, streams, mining debt are maybe kind of alternatives to like traditional project financing, right? But none of them are usually a substitute for the equity. So therefore, the real shortage in the marketplace is in my opinion the equity. Yeah, is actually it actually looks like, for all intents and purposes, that it's easier these days to get the debt than it is to get the equity. Yeah. I mean, I certainly, I mean, I've been in the industry also for a long period of time now, and I certainly can't remember another period in my career where you quite regularly see projects that have raised the debt, but actually struggle to find the equity. So that's certainly something that's new to me. Something that we observe with some regularity. So the issue is not on the debt. I think there's enough debt out there. Yeah. I think the issue is on the equity side, and then the question is, where else would the equity gonna come from? If the public market doesn't underwrite the equity in sufficient quantities, if the pool of private equity is not big enough, I can't give you a clear answer to that question, because we have certainly seen a lot of sovereign wealth funds having become very gun shy to assume development risk. Very happy in producing assets, but assume development risk. Large mining strategics would certainly be part of the answer, but sometimes the combination of entrepreneurial risk capital with large mining companies is not so easy. Yeah, because entrepreneurial mining companies think very capital efficient to achieve as much as fast as possible for very limited dollars, and sometimes large mining companies operate somewhat differently. So. So that is maybe not necessarily the answer for the real risk capital end of town. In some cases, it will be government support, I would say, because in some cases, governments, especially now with increased sensitivity to kind of local supply chains and domestic supply chains that are less vulnerable to disruption, in some cases, I think you'll see governments coming in to support certain entrepreneurial project initiatives. But again, that's not going to be the answer for everyone. I think that's going to be the case in a few particular situations. Yeah, I don't think that's a large scale solution. Yeah, I'm not sure. Honestly, I'm not sure, despite the fact that all the rationale argues that the risk equity gap in mining needs to be filled. Yeah, I'm not sure where all the required equity is really going to come from.
And so I guess what do companies do in the meantime, or companies, especially those looking to develop these kind of clean energy metals and everything that's required for decarbonization? What do they do in the meantime?
trying to be as creative as possible about how they raise finance. And I mean, look, I mean, it's of course true that probably the very best of those companies, or that many of those companies that are really, really good, will probably stand a chance to raise the equity. Yeah. But not all of them. I mean, we have certainly seen a number of companies that you'd normally think are really worthy of funding that have failed to attract the funding. Yeah. I mean, some of them will succeed in raising the equity, but many will not. And I think the only word of advice that I have, if I were in their shoes, is that I would say make sure that your investment case is as robust and bulletproof as possible. Yes, really low on the cost curve. In some cases, that you have a really clear answer what's going to happen further downstream, because a lot of this kind of technology and kind of electrification metals and minerals actually also require significant downstream component. Yeah, like in lithium or earth, it's not just about the mining. Equally important is actually also what happens further downstream, right?
Yeah, absolutely.
To actually have a really clear answer for the capital markets, what's going to happen on the downstream, to be actually really low on the cost curve and have genuine high quality projects. I know all of that sounds self-explanatory and obvious, yeah, but it's just often not the case. Yeah. And I think that's and be as creative about financing as one can.
Yeah.
There's no universally applicable answer to all of these challenges. I mean, every situation is different.
Yeah, absolutely. So I guess it's more of just kind of a be creative and have kind of the right investment selling point for your company.
Yeah, and only hit the market actually if you have a project that's actually really good. I mean, you know, you see, that's actually one of the dislocations in the junior mining markets, that every company typically only has one project. A few have two projects, but most of them have only one project, right? So the people who invested into these single asset companies and the people who run these single asset companies, they have already made their bet that it's going to work. They've already committed their time. They have already, in some cases, committed their seed risk capital dollars, right? So for each of them, even if the project does not make a lot of sense, yeah, many of them will still soldier on and try to raise the capital for that project, because that is their bet, that particular project in the particular junior mining company, right? So therefore, they will do whatever they can to basically attract the third-party capital that's necessary to advance that company. Now, while that is understandable from an individual point of view and from an individual company point of view, what it, however, also means is that it creates this very large universe of junior mining companies, yeah, all of who try to raise capital to advance themselves, with a very, very high percentage of those companies in reality not having any worthwhile projects. And that of course contributes to confusing the investors. Yeah, because you have investors who only have a limited amount of capital, a limited amount of time, yeah, and now you actually also have less equity research than in the past because of all the banking regulations. Yeah, so you got less equity research in the past as well. So that is also a negative contributor. And you have the investors looking at these thousands of junior mining companies, and I'm like, okay, how the heck I'm going to figure out who is actually really good? Now, for mining savvy investors, that's not a problem. Yeah, but the larger capital markets are often not necessarily populated by mining savvy investors, but often, in many cases, often more by generalists, right, who might be confused by that. It also, I mean, it also doesn't help, of course, that a lot of these listed junior mining companies are actually misallocating capital. I mean, again, coming back to my 6.8 or $6.9 billion equity raise to the last 12 months number before. Yeah, according to the public information, about 22% of that amount of money is actually for general corporate purposes. So you look at that and say 25% of equity raised in mining over the last 12 months has been used for project development, and 22% have been used for general corporate purposes. So basically you're saying almost as much money has been spent on general corporate purposes than on developing projects. Now, that is a ratio. That is a ratio. Does not make a lot of sense.
Yeah, absolutely.
I mean, it's not capital efficient.
Mm-hmm. Yeah, absolutely.
Because G&A money ultimately, you know, I mean, if you've got a great management team that is accretive, but by and large, a significant portion of these corporate overheads, right, where listing fees and office rents, you know, and whatever, board members, et cetera, that is actually not accretive capital in the ground. That's actually creating value, right? A lot of that capital doesn't create any value. A lot of these corporate overheads, right? So that's actually, dead capital at the end of the day.
Interesting. So I guess also be careful with how you allocate capital within the company itself, and make sure that, you know, you're governing properly. And absolutely.
And it's tough, you know. I mean, it's tough. I mean, even for us as a mining specialized investment firm, we've actually quite a lot of experience in what we do, right? I mean, it takes a lot of time and energy to filter through the opportunity set and actually to try to figure out who is actually for real and who is actually having a genuinely attractive project. Yeah. If that is a major effort for us, with the resources that we have as an investment firm, I mean, I must assume for a normal retail or institutional investor, it's much more complicated.
Yeah, absolutely. And is that one of the criteria you look at, you know, within a company, how they allocate their capital, when looking at a strong investment? I mean,
look, I mean, for sure. I mean, again, we obviously we look. I mean, first of all, we look at, does the project make any sense? I mean, that's from an asset point of view, and is it really low cost? And I mean, also put the spreadsheet aside and the feasibility studies. Yeah, there's the represented economics, but there's also the reality of implementing projects, right? We try to focus on projects that have a lower execution risk, a lower implementation risk, right? Because within metals and mining, there's actually quite a broad bandwidth of kind of technical risk profile. So we try to focus on those projects that are actually the lower end of the technical risk curve, right? So we look at that. We look at the reality of implementation risk. Obviously, we look at the economics, right? We are quite well known for having a back and management team approach. So actually, the first thing that we typically look at is actually the quality of management. And very often, we start business planning with management teams before they have the assets. Yeah. And then basically, we agree with a new management team what we call a hunting license, which means we go with the management team after projects and mines that actually fit to what the management team has successfully executed in the past. Yeah. So we want to make sure that we only back people with capital to do something where they already have comparable scars on the back, right? So the people are really important for us. Obviously, the asset's gonna make sense. The execution risk is really important. And now, because we probably still have another 12 months of COVID-19 travel restrictions in front of us, Amy, one of the things that we look at is, can we carry out due diligence? So, because we don't believe in due diligence where people send around drones flying and have GoPro live streams and things like that. We gotta be able to send trusted people to site, where they themselves can kick the rocks, because if you rely on what people send you remotely, then you only see what the counterparty wants you to see. Yeah. So there is no substitute to having your own people on the ground with the boots on the ground of the project and take a look at things. Yeah. So that means we only at the moment seek to transact in jurisdictions where we can mobilize a critical mass of locally resident geological and engineering and metallurgical talent who can carry out due diligence on our behalf, but in close cooperation with our own in-house technical capabilities. That rules out a significant number of countries in the world. I don't want to withdraw now which countries are in and which countries are out, because that's also changing with some regularity, given how travel and quarantine restrictions are changing. But we certainly had to pass on a number of transactions in Africa, actually, not so long ago, because it was literally impossible to get due diligence teams on site. You'd need to charter planes and had several months waiting lists for getting landing permits, and then teams would have to quarantine for 2 weeks before departure and 2 weeks upon arrival, and then again. So before you know it, people would spend 6 to 8 weeks in quarantine for only 3 or 4 day site visits. So like an impossible proposition.
Yeah, it doesn't.
So logistical ability to carry out due diligence is also at the moment also one of our key filtering criteria in our deal pipeline. Now, one would hope as a vaccine gets rolled out over the next 12 months that actually the travel restrictions around the world are going to relax. But right now we still look at a situation where we have, in order not to waste our time and also not to waste anybody else's time, we only want to look at transactions where we see a realistic chance to be able to carry out due diligence.
Yeah, absolutely. Well, let's hope that the vaccine rollout happens a little bit faster than expected, and we can all get traveling again. And
it's a real obstacle, I need to tell you. It's a real obstacle, because it's not only the technical due diligence. I mean, in a lot of deals, you're either in partnership with other people, right? So you just, while Zoom calls and WhatsApp calls, that's all helpful, but you can only progress a transaction commercially up to a certain point via electronic media. There just comes a point where you just gotta sit down with a potential counterparty, not once, but 3 or 4 times in a row. In some cases, have dinner with them, crank up a bottle of wine, look them in the eye, and figure out, can you work or coexist with these people in a business venture or not, and vice versa. So the human component of deal making, in most cases, or in many cases at least, cannot be entirely replaced with electronic media.
No,
unfortunately.
Absolutely. And well, so hopefully we can get back to all of that soon enough.
Knock on wood, Amy.
I know. All right,
I've never traveled so little as I'm doing. Like I've never been outside an aircraft for as little as the last 20 years or something like that.
No, so. Absolutely. It's been a very, very quiet year. So,
yes.
Well, thank you, Bert, for joining us today on Assay TV. No. This has been very enlightening.
Thank you, Amy. It was a great conversation.
And hopefully things get back to normal soon enough.
Absolutely. And all the best to you in Hong Kong. Thank you.
You too.